Welcome to this explainer. Okay, so picture this. In boardrooms stretching all the way from San Francisco to Riyadh, from Singapore to London, there's basically one massive question dividing the world's most powerful investors right now. Are we watching the birth of a brand new industrial age, or are we witnessing the inflation of the absolute largest speculative bubble in financial history? Today, we're going to look way past those flashy product launches and soaring stock prices. We're uncovering the hidden financial architecture that's literally building our future.
Get a load of this number, $500 billion. By 2026, the world's biggest tech companies are on pace to spend more than $500 billion in a single year. And get this, they aren't spending it on new consumer gadgets or hiring more people. No, this money is going purely toward infrastructure. We're talking massive, sprawling data centers, custom chips, power plants, and cooling systems stretching across deserts and farmland. To put that into perspective for you, that is an amount larger than the entire economic output of most nations on Earth. It's just staggering.
Even the tech executives themselves are making these wild historical comparisons. You'll hear them compare this current build-out to the massive expansion of the 19th century American railroads, or literally the electrification of entire continents back in the 20th century. And, well, you kind of have to ask why. Because framing this as a generational national infrastructure project really helps justify spending that would honestly look incredibly reckless on a normal quarterly earnings call. But history tells us booms of this size really only end in one of two distinct ways, which we'll get into in just a bit.
Section 1. Peeling the onion. Who is actually paying? So, first things first, we really need to understand that this isn't just a technology story. At its core, it's a finance story. It's all about debt being issued, equity being raised, and risk being quietly shuffled from one balance sheet to another. So we've got to methodically peel back the layers underneath every AI chatbot to see the gears actually turning, which brings us to a huge question. Who is actually funding all this infrastructure? The popular narrative, the one you probably hear on the news, is pretty simple, right? A handful of incredibly cash-rich tech giants are just paying out of pocket from their massive profits. But you know, if we actually follow the money, the truth is a much more complex, layered mystery. It's definitely not just tech companies footing the bill here.
Let's trace out this hidden flow of risk, because it's fascinating. Step 1. A growing chunk of data center construction actually isn't funded directly by the tech giants whose logos are slapped on the buildings. Instead, it's done through joint ventures and special purpose vehicles. Why? To keep that massive debt completely off their main balance sheets. Step 2. This structure is largely financed by private credit funds. That's a booming sector operating with way less public disclosure than your traditional banks. And Step 3. When private credit gets involved, the ultimate destination shifts the risk straight over to institutional investors, meaning the ultimate backers left holding the bag are often insurance companies and ordinary pension funds. That's right, it could literally be your retirement account quietly backing this massive AI build-out.
And the physical footprint of all this? It's absolutely massive. These data centers demand just staggering amounts of electricity. Because of this, utility companies across the US, the Gulf states, and Asia are committing tens of billions of dollars to build brand new gas plants and even restart dormant nuclear facilities. And they're doing this entirely on the strength of contracts with these tech companies. So here is the absolute crucial point. If the demand for AI computing power slows down even a little bit, tech shareholders aren't the only ones who are going to feel it. The financial burden will fall directly on ordinary utility ratepayers, bondholders, and everyday electricity customers, like us, who will suddenly have to cover the massive costs of these newly built power plants. And then, of course, we have to sprinkle some geopolitics into the mix. Gulf sovereign wealth funds, Asian state investors, and national development funds have totally stepped in as major financiers here. They are treating computing capacity exactly the way nations once treated oil reserves. It's viewed as a critical strategic asset, something worth heavily subsidizing regardless of whether it makes a near-term financial return. So when you put it all together, we're looking at several interlocking financial systems: corporate balance sheets, private credit, utility debt, and sovereign capital, all of them making the exact same massive bet at the exact same time.
Section 2. Dueling perspectives. The bull case versus the bear case.
Now, to keep things completely impartial and figure out where this is all heading, we need to look at how the smartest capital allocators in the world are currently, and I mean bitterly, divided. There are two very distinct camps here, and honestly, both make really compelling arguments. On one side, you have the optimists making the bull case. They argue this spending will become the essential backbone for decades of future growth. They'll point out that, hey, unlike the dot-com bubble, this is largely funded by retained earnings from highly profitable businesses, and we're already seeing real, measurable productivity gains in sectors like healthcare and logistics. To them, it's a lot like the fiber optic overbuild of the 2000s that eventually made cloud computing possible. On the other side, though, you have the skeptics making the bear case. They fear we're building a graveyard of stranded assets. Their core argument is that this infrastructure spending is running dramatically ahead of any proven, durable revenue, and they worry that capital is overbuilding based purely on hype, propped up by those hidden debt structures we just talked about.
Those bears also point to a much quieter, sneakier concern: depreciation. Basically, tech companies have been extending the assumed useful life of their servers and chips on their accounting books. By spreading the massive costs of this AI hardware out over more years, it artificially flatters their current earnings. It makes the numbers look a lot better today. But here is the massive risk hiding in the math. Given the blistering, breakneck pace of chip innovation, what happens if this AI hardware becomes obsolete way faster than they assumed? These companies could face sudden, massive write-downs that would absolutely crater their earnings in a quarter that nobody saw coming. And remember, these risks don't just exist in a vacuum. We've got unproven long-term pricing power colliding with a really tricky macroeconomic environment right now. I mean, we're looking at elevated global inflation, persistent geopolitical conflicts that keep disrupting global energy markets, and central banks that are super cautious about cutting interest rates. And higher rates make all that debt-financed infrastructure so much more expensive to maintain. Plus, a tiny handful of tech companies now make up an outsized share of major stock index funds. So a single stumble wouldn't just be contained to some niche tech sector, it would ripple directly and painfully through global retirement accounts.
Section 3. The Global Board, a worldwide financial story.
This trillion-dollar bet isn't just a Silicon Valley story. It stretches across the entire globe, touching nearly every major economy, but it's impacting them all in strikingly different ways. If we zoom out for a second and look at developing Asia, places like Vietnam, Thailand, and Malaysia, they're experiencing massive real estate surges and high rental yields fueled by AI investments pouring in. Europe, on the other hand, is kind of playing catch-up. They face a very real risk of becoming just a customer of American and Asian AI infrastructure, rather than an owner. Over in the Gulf states, they're aggressively deploying their sovereign wealth to pivot their nations away from oil reliance and straight into AI. Meanwhile, India is riding this wave of market optimism with strong earnings and public offerings despite local trade pressures. It just proves that the broader global economic story and the AI story, they are literally the exact same thing. So as that $500 billion a year continues to climb, the truth is nobody credible actually knows for sure if this ends in a historic triumph or a colossal collapse. But it leaves us with this one haunting ultimate question. When an economic transformation of this magnitude is financed through such a complex, layered, and partially hidden web of corporate debt, private credit, utility contracts, and sovereign capital, who actually bears the risk if those promised returns show up late or worse, don't show up at all? That's the big takeaway from this explainer. It's not just a question of whether the technology itself actually works. It's a question of who's going to be left holding the bill if the financing behind it all falls apart. Thanks for joining me on this one, and I'll see you next time.